Good morning, IDSA members, and welcome to our November and last Boardroom Bite session for the year. Thank you for joining at last minute on a new link. And we see that many of you have already joined, so thank you so much. It's so lovely to have you all here today. Such a pleasure to welcome you all on today's topic, Safeguarding South Africa's Future. And it will be Isaiah Mhlanga who will be unpacking the implications of these indicators on the future stability of the nation this morning. I'm Yahandi Slabbert and I will be your host this morning. As usual, the house rules are that you can post any Q&A questions in the Q&A box, and we will address those questions at the end of the session. You are more than welcome to give us any comments or share any links with us in the chat box. With that done, let's dive into our presentation overview. Today's topic, Safeguarding South Africa's Future, will examine the latest economic and geopolitical indicators influencing South Africa's landscape. We will analyze key factors that serve as indicators of potential risks and challenges, discussing their implications on various sectors. Additionally, Isaiah will delve into actionable strategies to respond to the identified risks and propel sustainable growth. Isaiah Mhlanga is the chief economist and head of research at Rand Merchant Bank. He has more than a decade of industry experience spanning both the public and private sector. He started his career as an economist at the International Monetary Fund and then moved to National Treasury's Economic Policy Unit. Isaiah's technical experience includes econometric modeling and forecasting, macroeconomic analysis, and currencies. A warm welcome to you, Isaiah.
Thank you. Thank you very much. And good morning to everyone. And thank you for inviting me to come and share some of the views that we have as far as the economy is concerned and the global macro environment's influence into our own economy and society. So in terms of the outline, I have about 6 points that I would talk through. First, it is the global secular themes that are currently driving global inflation. We know we come from a decade to 2019 where inflation was at record lows in many economies and we got used to very low interest rate globally. That period is no more. We are now moving into a new regime where inflation is going to be structurally higher. And as a result, real interest rates or the cost of debt is going to be much higher than what we have seen in the last decade. And these are very long-term themes that would unfold over the coming decades in our assessment. And then there is the geopolitical fragmentation that we see. It started in more visible ways during the Trump presidency with the trade wars with China, and then it moved to a technology war again between the US and China, but it seems it's much more broader than that. And then we now have wars in Ukraine with Russia and the Hamas-Israel war that just broke up in the last 2 weeks or so. All of those are a continuation of the geopolitical fragmentation that is going to complicate the business environment in different countries. Also taking into account that we are a part of major trading blocs or alliances globally that would make it difficult for us to operate. And then from a macro perspective in SA, we seem to be stuck in a low growth trap, which does not generate enough jobs for the many millions of people that are unemployed, and as a result sets the ample environment for social instability. If you remember the 2021 July social uprising, that risk is still pretty much with us and is going to remain with us for a longer period, as long as economic growth is not able to lift people out of poverty. From a monetary policy perspective, inflation is back within target. Seems the Reserve Bank has achieved bringing inflation back, but it requires support from fiscal policy in order to contribute much more positively to economic growth. Monetary policy currently serves as an anchor as far as attracting capital into the country is concerned, but what is much more durable is a sustainable fiscal position that can attract foreign direct investment. Monetary policy can only help as far as portfolio flows are concerned, and that is hot money. We need fiscal policy anchor for us to be able to attract long-term capital that can be invested in our economy. And then the last point would be trying to frame the question on whether the private sector can reform the economy. I think it's one of the debates that is always had to say government needs to do that. We have always, debated on what government needs to do for a very long time. The role of the private sector in the reform of the economy is not as much in the spotlight in certain instances. And I would want to make a case that we have seen different areas where the private sector has stepped into what we understood as public goods, and the private sector played a role when government failed. And my submission would be, in some of the issues that we have, the private sector can play a much more meaningful role than what it's currently doing in a way that can actually reform the economy and lead to faster growth. So that's the outline of my presentation today. So let's begin with the secular themes. These are themes that are going to unfold over a longer period of time. From where we're coming from, low inflation, we still have some factors that will continue to drive inflation downwards. So income inequality, high debt levels, automation and digitization, the whole artificial intelligence, developments, demographics, essentially, all of those, they still lead to a disinflationary, trends. And we've seen these unfold in Japan as the population aged. But also, if you look in terms of where income inequality is very high, we tend to also have, disinflationary environment, because income is concentrated in a small proportion of the population, which doesn't spend as much and spend on, very few goods and services, and mostly save. That normally depress inflation. And then if you look on the side of an inflationary themes, the regionalization or the great power struggle that's taking place, visible between China and the US, but it's also between other countries other than those two. Regionalization itself, meaning taking production where it was to closer to your own shores or to countries that are more friendlier, actually requires more investments in new factories, which implies a greater demand for goods and services, at least over the medium term. And that is inflationary. We have also seen a wave of populist policies across the world, which have increased debt levels, which is on the other side, and where populist policies lead to a broader distribution of capital or money, it actually can result in inflation if productivity does not pick up. Commodity prices will likely remain elevated due to the requirements of ESG. The environmental requirements still require a lot of mining of the critical minerals that are related to the decarbonization. And that will continue to, that will be inflationary. Where there is shortage of skills and the labor force is shrinking, it normally bids up the cost of labor, and which ultimately results in higher inflation. So these themes will continue for quite some time. The potential implications of the generative artificial intelligence technology, it's still not yet understood. But as we read it, we get a sense that there is a productivity effect if we combine labor and machines, we generally tend to get a higher productivity effect. But it also displaces some workers, particularly those that are in the repeatable functions. It normally displaces that, which means there has to be a response in terms of reskilling part of the populations that are going to be displaced. And then in terms of the potential short-run impacts, it's an increase in productivity, which should be disinflationary. If you look at the impact of China's increase in productivity over the last decades, it has contributed into much lower global inflation. So the generative AI that we currently see will also have a similar effect in our assessment. The long run impact, inflation will come to target, at least over the short term, which would mean that central banks will have an opportunity to reduce interest rates over the short term. But over the long term, inflation will be structurally higher because productivity is going to increase. So the period that we saw to 2019, where we had quite controllable inflation, low, close to target in the advanced economies, much lower than that, is not going to repeat, at least in the next couple of decades, because the fundamental structures of the economy are shifting. And as a result, we will tend to have generally higher inflation, generally higher interest rates, which will increase the cost of capital for many businesses. And then there's something that we normally say in our economic parlance, the natural rate of interest. Essentially, that just means the rate of interest which prevails when the economy is operating at potential. That's the R star. Over the last 3 decades, there has been a systematic reduction in that natural rate of interest, which influences where central banks tend to set monetary policy and therefore the cost of capital. We have seen a decline in that natural rate. What we should expect going forward is the reverse of what we saw in the last decades. And a couple of things that influences it: demographics, total factor productivity, and capital flows. All of those, they have influenced the natural rates of interest in a downward direction, and we are likely to see the reverse. And then we have fiscal policy, which also influences natural rates. And so far, we have seen across the board an increase in debt levels, both in emerging markets, but also in the advanced economies. It's much more critical for emerging and developing economies because they do not have reserve currencies as the advanced economies have. But if you just look in terms of total factor productivity, which is potentially the most important across all of the drivers, you can see in the US, it drove about 38% of the decline in the interest rates over the last 3 decades. In countries such as France, 55%, in Germany, also about 38%, and in Japan, about 30%. The situation in emerging markets is slightly different, given that we still have structurally higher interest rates compared to advanced economies, because our total factor productivity has been much weaker compared to the advanced economies. Some survey of where natural rates of interest are likely to land in the next decade. If you look at where we come from pre-pandemic, in the US, about 0.5% in real terms. In COVID to now, about 1%, and expectations are that is going to be somewhere between 1.5 and 2%. And that is quite critical because it sets the base for all emerging markets, because that is what is generally referred to as a risk-free rate, on top of which we add other aspects such as credit risk, currency risk, to arrive at what South Africa should have as a long-term interest rates. So across the US, the UK, and in the Eurozone, there is an increase in the expectation of where natural rates are going to end up. Japan, not so much, given that it is very low inflation. relative to other advanced economies. So just a summary of the global cyclical macro themes that we should think about as we move into 2024. We have incremental downside risks to growth that are driven by still tight monetary policy. Central banks, though they are close to peak interest rates, they are signaling higher for longer interest rates because inflation is still quite sticky, particularly the underlying core inflation. Tightening lending conditions will continue for quite some time, driven, of course, by borrowing costs that remain high, which means there is going to be lower credit availability as financial institutions respond and try to anticipate the increase in non-performing loans. And we are seeing this in the US outside of the housing market, which has fixed interest rates, about 95% of it. We are seeing it in the car financing and credit cards, where we are starting to see an increase in non-performing loans. And then we have systemic financial risks, which we saw a bit of in March this year with the regional banks in the US. These are much more prevalent in other countries, but at a smaller pace, because we continue to see central banks that are quite worried about systemic risk, and as a result, the expectations for increase in interest rates have now peaked. That is in part to try and stem the global financial risks. So in a way, that is also a reason why inflation is going to remain structurally higher, because central banks have a limit in terms of how aggressive they can continue to hike interest rates without causing financial risks in different economies. And then for the US, still a risk of a government shutdown. It was avoided or at least postponed for 45 days to 17th of November, where they would have to again reach an agreement to keep government open and increase the debt limit. That remains a risk for financial markets, but that is more of a short-term rather than a long-term risk. And then the Middle East geopolitical risks remain, and I'm going to speak in the next couple of clicks on this. The expansion of the geopolitical risks with the Israel-Gaza war so far has a negligible impact, but it poses risks if it becomes a region-wide in a way that is going to impact negatively energy markets. If you remember the Ukraine-Russia war, when it started, not so much was understood in terms of how its impact in the energy markets and grain markets was, until a couple of weeks when we started to see shortages in other countries, which drove inflation very high. Something similar, if the war enlarges or spills over to a wider Middle East, particularly if it involves Iran, which supplies about 2.3 million barrels per day in terms of oil to the global market. So that's a major risk, and we'll provide some scenarios on what it means for oil, what it means for inflation and for global growth. The global disinflation will continue, but it will be quite slow given the potential impact on the financial system if central banks continue to hike rates. So if we just look on some of the things that we really need to think about from a policy perspective. On the US, the Fed is expected to hold rates steady where they are, between 5.25 and 5.5%, with a cutting cycle starting in the first half of next year. We still think a US recession is coming, postponed, and happening in the second half of next year. And that would be the reason why the US Fed will start to cut rates towards the end of the first half of 2024. China risks growth has been poor relative to expectations. The Chinese authorities have implemented some stimulus on monetary policy on the margins, and over the last 2 weeks, they have implemented fiscal stimulus of about 2 trillion renminbi. which is a recognition that the Chinese economy is underperforming and has potential to cause social instability. And the Chinese authorities, they care a lot much about social instability in the current environment. And this has implications for our own economy through commodity prices. If you remember the last 2 years, we had better than expected tax revenue collections because commodity prices were performing well. The mining sector and the banking sector did very well. We are now in a different environment. Now, let's move on to the geopolitical fragmentation along trade, technology, and war. The chart that I'm showing now gives a sense of the change in global trade with the US and China. 124 countries, they list China as their largest trading partner, relative to about 56 countries that list the US as their largest trading partner. This signifies a significant shift from what we understood in the decades gone by, where the US was the biggest trading partner for many of the countries, which simply means if China then decides or persuade countries to settle these trades in renminbi, there is potential risk for the dollar's influence in the global finance to reduce. We're not seeing that as yet, but the risks are quite prevalent going forward. And if you just look at the reduction of the holdings of the Chinese central banks of US bonds, it has been quite significant over the last 12 months. But we have also seen China asking countries such as Zambia, for instance, and other countries that it trade with from an oil perspective, Russia, to say they need to settle with renminbi outside of the dollar. That's still on the margin. But if we were to project forward, that means the risks are there. But also a different way to interpret this is China is no longer a small country. It's a big country that can go head to head with the US in many instances, which then heightens the trade wars, technology wars that are taking place. You would remember, the reports on the damage on Huawei when the US imposed some restrictions on them, but also on Apple in China when the Chinese authorities also retaliated. Even when we go back to the Trump trade taxes, Chinese authorities responded in similar measure to the US, which was negative for global growth. So it means the fight between these two countries would have negative consequences for the global economy and for emerging markets in particular. And then we now have the BRICS Plus, which is an expanded groupings of countries in addition to the original 5 member countries. In there, if we look from a geoeconomic perspective, we have 3.7 billion people now residing within these 11 countries. 40% of global oil production is now done by the members of the BRICS Plus, and 30% of global demand or global oil consumption is now within these BRICS Plus countries. Let's say, as a scenario, these countries so choose to trade in their own currencies away from the dollar. What would it mean for the prevalence of the dollar? It's not yet happening, at least not across all countries, but India and Russia are no longer using the dollar to settle oil, which is already a signal of what is likely to take place. And in there, we have countries such as Iran that are sanctioned by the US, which as South Africa, we will have to engage with as part of the BRICS Plus. And part of the benefits is to increase intra-trade between these countries. And hopefully we would not be caught up in a trade of oil with Iran, which might expose us to potential sanctions by the US, because we're still pretty much a country that has significant use of US dollars in terms of settling our import bills. So therein lies the potential risks for sanctions in future, depending on how we are going to engage with some of the countries that are sanctioned by the US. So there are risks, but also there are opportunities in the BRICS Plus. You will remember China's One Belt, One Road initiative. There is another one, the India, Middle East, Europe Economic Corridor with the US, Saudi Arabia, and the European Union as part of them, whose intention is to counter China's One Belt, One Road initiative. So you have India and China that are members of BRICS, which are supposed to be collaborating, but you also have India as part of another bloc that is countering China. So in this instance, we're friends and enemies in the same groups, which just means it's going to be quite difficult for multinational companies that operate across jurisdictions to operate. Where do we choose if you are to set up a hub in Asia? Do you go to China, in which case you still need to operate in a dollar space, which is governed by the US, or do you go to India, which is also in a sort of long-term conflict about the border with China? So it becomes quite difficult to operate cross borders. So instead of mending relations and improving globalization, we are seeing further fragmentation of the global economy along trade, technology, and now we have several wars that are taking place in key regions that have significant implications for markets and economies. So this just means higher volatility and more uncertain. The typical VUCA world, if I were to put it that way. It's much more complex. It's highly going to be volatile and uncertain for many businesses to operate. And these are risks that would need to be managed. Just to give a sense of the de-dollarization that has been touted for quite some time, in part because of the enlargement of the BRICS, there's expectation that the dollar is going to significantly decrease. If you look at the chart on the left-hand side, it just shows you the share of dollar use as central bank reserves, which have declined from 66% to about 59%. Non-financial foreign assets, not much of a big decline from 51 to 49%. And then total cross-border liabilities from 51 to 47%, so marginal declines. And as far as debt securities, we've actually seen an increase from 34 to 39%. As far as settlement of trade through SWIFT, not much of a big, a decline from 44 to 42%. And in foreign exchange markets, it has remained relatively stable. If you then look on the chart on the right-hand side, it actually shows potentially it hasn't been de-dollarization, but de-euroization, if we were to coin a phrase that way, where we have seen the share of payments of through euros going through SWIFT declining from 38% to 23% in a space of 9 months, while the dollar's use have increased. So perhaps it hasn't been China's strategy to reduce the dollar, but to take a share out of Europe, because Europe is vulnerable, currently experiencing a war in Ukraine with Russia. And if you go back to 2012, we also had the potential split of the euro area, given the fiscal issues that they had at the time. So we haven't seen as much the decline of the dollar as is the expectation, but we have seen the decline of the euro in terms of payments. 3 scenarios of the Hamas-Israel war in terms of the impact on the global economy. So far, the market is operating on an assumption that it's going to be a confined war between Israel and Hamas in Gaza and the West Bank. The impact has not been large. Oil price increased by 7% on the day after the Hamas attacked Israel, and they have since given up all those increases, which means oil prices have moderated. But what we are seeing now is something that looks like a spillover war into Lebanon, and potentially it might go into Syria soon. That would be a proxy war that would involve Iran and Israel. And that would have a negative impact compared to what we currently assume, or at least what the market currently assume. On the extreme, if there is direct war between Israel and Iran, then we will see a bigger shock in energy markets. And there have been studies that try to give us a sense of what that impact looks like. If we just follow the news flow, it seems to us that we are now gearing up for a proxy war that is no longer what the market currently assumes. Because the market assumes it's going to be confined, but we now have seen a ground invasion of Gaza by Palestine, but we also now have Lebanon that has outrightly declared that it is now at war with Israel, which means we are getting other countries that are being drawn into the war. The risk there is if Iran gets directly involved, then it becomes a region-wide conflict, which will have negative consequences for markets. So what are the scenarios? These scenarios have been parameterized on the basis of the 2014 Gaza war, 2006 Israel-Lebanon war, and 1990-1991 Gulf War. So we look at what was the impact then and try to place the current conflict in that context. Confined war, which is what is the current assumption, marginal impact on oil, which means it's just a $4 per barrel increase. As far as volatility in markets is concerned, no impact as yet. And the impact on GDP, very marginal, minus 0.1 percentage points, that is global GDP. And then on impact on inflation, it's a +1 percentage point. So very, very marginal impact, almost not negative. And if we see a proxy war, which is where we are gearing towards, if we just look at the developments over the last week, oil price likely to increase by $8 per barrel from the current levels. Volatility rises by 8 points. And then global GDP reduces by 0.3 percentage points. Inflation rises by 0.2 percentage points. In the event that it spills over into a direct war and region-wide, then there's a potential for oil prices to increase by $64 per barrel on top of the current base. Volatility in equity markets rising 16 points, and a full percentage point decline in global growth, and a full 1.2 percentage points increase in global inflation. That easily tips the global inflation into a recession, a global economy into a recession. That is on the basis of what we have seen historically. So we will have to continue to watch where is it going and what scenario it's likely to end up in, so that business can prepare for the potential negative impact. If you just consider a $64 per barrel increase in oil, that's very inflationary, particularly for oil importing countries such as South Africa. And in that environment, we also tend to see capital outflows, weak currencies, that increases the cost of servicing dollar debt or foreign currency debt, which means quite a number of countries, particularly emerging markets, will be impacted significantly in such a scenario. Debt defaults will be much more prevalent, particularly across sub-Saharan Africa, where we have already seen countries such as Zambia and Ghana being in significant difficulties, even without such a significant shock in the economy. Now let's then look at some of the global macro backdrop. That is, obviously we start from the US as far as Fed funds rates are concerned. The way to read the table is, if we just look in terms of where the interest rate expectations are currently between 5.25% and 5.5%, there is no expectation that we are going to change. So the probability that it's going to remain there is currently 90.7%, which means no expectations of change. The 5.5 to 5.75%, the probability, which are largely in red, that column, it still remain below at 30 or below 30% probability, which means unlikely expected. And then as we move into 2024, cumulatively, 75 basis point cuts in interest rates that are expected. That should also be the basis of why the South African Reserve Bank should also start to cut rates in the second half of next year. US recession, still an expectation over the next 12 months. It has been postponed or delayed rather than avoided. Three key reasons for that. Fiscal policies still remain quite loose. Monetary policy, or at least in terms of the US Fed's response in March, pumping in $200 billion over a space of 2 weeks when regional banks failed, that also postponed. And then excess savings from the pandemic era cash transfers, which are now depleted, have supported the household sector. As far as the Chinese economy is concerned, confidence seems to be recovering somewhat, but it remained quite low. If you look in terms of retail sales, remain quite weak. If you look in terms of surveyed unemployment rates, weekly hours worked, if we just look at the deviation from trend, they still point in the negative direction, which is why we have expected fiscal stimulus to be announced for some time. And then if you look at other sectors, the industrial sector, for instance, remained resilient, which is one of the growth engines of the Chinese economy. And this, in a way, helps to support commodity prices. So if you look at construction, industry, that's manufacturing, and then services, they all continue to point in the upward direction. And then if you look at construction activity, particularly for new property starts, that is depressed, which is something that we have been concerned about for quite some time. The China's property market has continued to be a drag on its growth, and that constitutes 20% of the economy. So until the Chinese authorities respond to the property market, the Chinese economy will continue to underperform in a way that is going to continue to have negative implications for commodity prices and therefore for our terms of trade. And then let's look at South Africa's macro fundamentals. Growth remained quite weak relative to the budget time this year. We still relatively okay as far as the near-term growth is concerned. Treasury was forecasting about 0.9%. Currently, if you look at consensus expectations, roughly at about 0.7, 0.8, so not much difference, but the quality of that growth has changed in a way that it is now impacting tax revenue collections. But over the medium term, growth continues to remain below 2%. And for us to be able to reduce unemployment rate, we require growth of 3% on a sustained basis, which is way higher than what we are currently projecting, which means we actually need a stronger economic reform agenda for us to reduce the unemployment rate. So far, the growth path that we are currently under breeds room for social unrest because it's not able to reduce our unemployment rate. From an inflation perspective, last print was just about 5.4%, still within the target, was a slight increase from the previous print, but in the broader schemes of things, inflation is under control. Expectations for crude oil prices, assuming again a confined conflict in Israel, between Israel and Hamas, we expect oil prices to moderate from current levels where they are, which should bode well for overall inflation and therefore monetary policy. The currency is oversold due for appreciation. Perhaps for many, because it's too weak, the expectation is it's going to remain very weak. But if you look over the long term, as I will show in the next click, currency always recovers along a long-term trend. From an interest rate perspective on the right-hand side, we think interest rates have peaked and we should start to see cuts in the second half of next year, beginning in July. Cumulatively, 75 basis points of cuts that we are expecting over the course of the second half of next year, which should help in terms of debt servicing cost for consumers, but also for corporates. And then if you look just over the long-term trend, just to demonstrate that the currency always recovers, the blue line is the long-term trend weakness in the currency, which is that the inflation differential between the US and us, 2.5% on average. That's the depreciation we should expect on the currency. But along that long-term trend, we tend to overshoot extreme periods of weakness, and then we undershoot when the currency appreciates significantly. Currently, we have overshot. The currency is too weak relative to where it should. Our fair value assumption 1650, which means it's due for appreciation. But for that to happen, we need to see a very strong, a very weak US dollar, which tends to happen when the US Fed start cutting rates. That's the story of late first half of next year. We should see a weaker US dollar. Commodity prices must perform, which also tend to coincide with the weak US dollar, and South Africa's economic growth must also stabilize and improve. Then we will see a significant appreciation of the currency. In terms of what we expect to be announced today by the finance minister, from a budget perspective, fiscal policy is quite key. It anchors long-term expectations for interest rates. Revenues continue to underperform. If you look at gross revenues, excluding SACCO revenue payments, we have outperformed marginally. But if you look net of SACCO revenue payments, we are going to see an underperformance of revenue. On the spending side, we've overspent on salaries and wages. Treasury has budgeted over 3% increase. Eventually, they gave public sector employees a 7.5% increase in wages and salaries, which means an additional 20 to 25 billion rand that Treasury did not budget for this current year, and we still need agreements for the medium term. And then we have the SRD grant, the 350 rand per month, which is paid to some 8.6 million people, costing the state about 36 billion. It's not budgeted for beyond March 2024, which means it has to be budgeted for, and we expect it to be extended indefinitely. It's difficult for any government to take that once it has given it. But there's also been push from unions that it must be inflation linked, which means must be adjusted with inflation every year, which then raises the cost from 36 billion to 60 billion in 3 years' time. That would require to be budgeted for, which means we are likely to see a significant fiscal derailment if we hold expenditure on the current run rate. It means that we will have a significant deficit of about just over 500 billion rand from under 300 billion rand previously, and that money would have to be borrowed from market. So what we did is just to look at the current run rate to say, if we just consider from April to August, what is the gross tax revenues, and then what is spending, and then try to generate some assumptions that will give us a sense of where are we likely to end up on a fiscal deficit, and what is Treasury likely to be able to implement. And we have generated some assumptions. If nothing is done on the current run rate, we end up with the column that is in the middle, which is relative to the budget column, which is the budget estimate. So the column in the middle, that means 6.7% fiscal deficit, which is higher than the nearly about 4% fiscal deficit, and our debt to GDP ratio rises to 75% from the budget's expectation of 72%. That's for the current fiscal year. And obviously, that is not what market can accept. A main budget balance that balloons by 196 billion rand, in addition to what Treasury has forecasted at 274 billion rand previously. So that's a significant fiscal underperformance. Our expectation is Treasury is likely to be able to cut by 5%, which is the table at the bottom. First column on that table, that's the budget. Second column, that's if nothing is done. And then the third column, which is the best case, 5.1% fiscal deficit. That's our expectation. Still a deterioration relative to the budget estimate, but much better compared to a situation of doing nothing. And that would mean 111 billion increase in terms of our fiscal deficit compared to what the budget has forecasted. And that's what we would need to go and borrow from the markets. Some other scenarios, or what would really be required just to cut completely back to budget from the current run rate, that will put us at 4.1% of fiscal deficit, which is closer to the budget, but that is not possible. And again, Treasury gave some guidance to departments to cut budget by 10%. That would not be achievable. It's almost impossible. That would keep us almost at the same, if not an improvement relative to what we had in February. So that these two scenarios, cutting back to budget or cutting by 10%, are not feasible, especially ahead of an election next year. As I finish off in the next few slides, this is the financing change or financing requirement that we would need to. Budget estimated that we will issue domestic long-term loans, 77% of the total financing requirement. What we have seen so far is the use of cash and short-term borrowing or short-term instruments such as treasury bills. That's what we have seen. It's too expensive to borrow long-term because of an increase in bond yields. So government has been borrowing short-term using treasury bills, which actually increases the risks for repaying those loans over the short term. Now, in terms of the debt to GDP ratio, taking into account the SRD grant, inflation adjusting that, and also taking into account assumption on salaries and wages, it will suggest that will continue to rise closer to 80% of GDP relative to Treasury's forecast that saw a peak under 75% of GDP. So our debt levels continue to rise. There is just no other way to see where Treasury is going to cut spending enough in order to control our debt levels. And as a result, our debt servicing cost will continue to take a bigger share of our overall spending. And then the last question, which is, can the private sector reform the economy? First, we show the reforms in energy, what they resulted into, at least from a response from the private sector. Chart on the left-hand side show the decline in Eskom supply of electricity, but it also shows the increase in non-Eskom electricity measured on the right-hand side. Chart on the top right, those are investments in renewable energy by households, 4.4 gigawatts of solar panels, batteries, and inverters. Chart on the bottom shows the project registered from the private sector since 2018, and you can see the change in regulation in 2022 resulting in 1.7 gigawatts of projects, and then this year alone, about 3.2 gigawatts in the first half of the year, relative to Treasury's forecast of 2.5 gigawatts for the full year. So in half the year, we have surpassed what Treasury was forecasting for the full year. That's the private sector responding to a conducive regulatory environment. Pipeline, 66 gigawatts, which translate to 1.3 trillion worth of investments if that pipeline gets implemented. And we can also see in terms of the response of the manufacturing sector, it's now more resilient, historically quite linked in terms of if we look at manufacturing production and electricity supply, but if you look much more recently, supply plunge, but manufacturing productions hold on, which means the private sector has built resilience such that load shedding in future will have less and less of an impact in the overall economy because of the response of the private sector. Transport sector, why we need reforms in the logistics sector. If you just look 2012 relative to 2022, the rail and road contributions in terms of freight payload and passenger journeys. Freight payloads constituted about 27% from rail and then declined to 16%. All of that went to roads. From an income perspective, that declined from 25% to 17%. and also that went to road. If you look in terms of passenger journeys, that's where the bigger impact was, was felt. Rail considered 63% of passenger journeys in 2012. It's now about, as of 2022, only 7%. All of that went into roads. So the reforms that are required needs to reverse all of this. But it also means that for the businesses that bought a lot of trucks, when rail is functional again, it means there's going to be some negative consequences for jobs as well, as much as for the business that went into that sector. Now, we also have issues in water infrastructure, 2 slides to go, which would need to be solved for the agriculture sector, for the mining sector, but also for the manufacturing sector, because they're heavy users of water. Now, the question that we're asking is, can the private sector reform the economy? And here is my demonstration that in some sectors where we understood public goods to be provided by the state, which has failed, we have seen private sector role players come in and play a significant role. This is just a demonstration. You might have used post office at some point in time when it was functional. Now we no longer use it. We're using private companies to courier our products. Private education has also come in where our basic education seems to be failing. Private healthcare, and again, private airlines. These are private sector companies that have responded into spaces where public sector provision of these services have failed. Now, if you buy this argument that we have seen the response of the private sector, which has stepped in what we understood to be public goods, why then should we doubt that eventually our load shedding will be solved, and then eventually we will solve our rail system and our ports? And if you buy the argument, it's a matter of time when, not if, the private sector is going to be able to solution for these issues. All that is required is for the government to actually say they can't run these things by themselves. They need the private sector, and put together enabling legislation that enables the private sector to provide these services in a profitable manner. Then last slide, the risks that we also need to be watchful for in the next decade or so. We try to put a 3-dimensional view into a 2-dimensional view chart. If you look across, that's the duration over which the risks materialize. If you look at, in the vertical axis, that's the likelihood. The higher you are, the higher the likelihood. And then the coloring, the darker it is, the more impact it will have if it materializes. So Eskom grid collapse, low likelihood, but it's a bigger impact if it happens. By 2024, that risk should be eliminated. Negative growth shock in China, moderate likelihood, moderate impact. Potentials US sanctions, that is related to my point earlier on with Iran as part of BRICS Plus, sanctioned by the US, and potentially if we do any trade with them, we might expose ourselves to that risk. A populist and unstable national coalition government in 2024, that risk is going to be with us for quite some time. And as we have seen in other countries, populism normally destroys economies. EU carbon taxes, potential negative consequences for different companies and the country as a whole, and then a repeat of the July 2021 social unrest, or even worse, that risk will remain with us as long as economic growth remain below 2% and unemployment rate remain very high. South Africa remaining grey listed, potential negative impact much less compared to others, but it's still with us for quite some time in our assessment. Via El Nino, so far it's regarded as a weak El Nino, and as a result, it's not expected to have a negative impact. But if it translates into a strong El Nino, it means 2 consecutive seasons of below average rainfall, which would have a negative impact in 2025, not 2024, because we're coming from a better season this time around. And then a deep US recession, the likelihood, as you see, continues to rise, but in terms of the impact, that's a story of 2024. And then the fiscal crisis into 2025, 2026, and 2027 is much more likely if we don't see a significant tilting of the budget from national treasury. That becomes a real possibility because the debt continues to rise, economic growth remain very low, and our debt service costs continue to crowd out social spending, which means the treasury would have to continue to cut some of the government programs in order to maintain fiscal sustainability. And that puts us on a path of fiscal crisis if nothing gets done or if growth does not improve. I think I'm going to stop there, and then we can take a couple of questions if they're there. Thank you very much.
Thank you very much. There's lots of questions, Isaiah. So let's start at, I'm going to go at the most recent ones that's more relevant to what you've just spoken. Could we please see, oh, listen, we'll share the slides with you at the end, so I'm not going to answer that question. Shamani's asking, if government was able to cut spending to the extent required in the region of 5 to 10%, in which areas would this be feasible and sustainable?
What we have seen so far is Treasury tends to cut fixed investment, not salaries and wages or current spending. Ahead of an election, it's easy to cut capital investment budgets because it doesn't impact on politicians, not immediately. But that in itself is not sustainable because it undermines future economic growth. What is required is to reduce the size of public sector, of government essentially, and increase productivity. If you look at salaries and wages growth in government, they have outstripped salaries and wages growth in the private sector, but the productivity element is not increasing at the same pace as salaries and wages. So in all likelihood, we're likely to see a freezing of capital projects across government. In any case, Treasury has already given that instruction to say, hold off if the tenders have not been put out for any capital projects, must hold them off, which undermines economic growth in future.
Pisa Bula is asking, is South Africa really heading towards a fiscal cliff? If so, how can business prepare themselves for the decrease in government spending?
Look, so far, we are not saying it's a fiscal crisis as it stands. We still have some leeway. But if no adjustments are done on a growth side to actually increase economic growth and therefore expand the tax base in terms of the number of people paying tax, and also expand the tax base from corporates that are paying tax because they are doing well generally, then that risk becomes real. And my last slide says from 2025, 2026, and 2027, that's where that risks become likely if nothing is done on the growth side, but also if nothing is done in terms of reducing the size of public sector. And there is a project that the president has announced in terms of streamlining government, in terms of reducing, combining some departments and trying to get some savings out of that. We have to wait and see if government is going to be able to actually do that during an election year.
Thank you. There are concerns that the country is experiencing capital outflows precisely when we need investments in the country. Can you provide the reasons we are seeing these and potential impact for business and the country?
So as far as capital flows are concerned, I think it relates to the change in Regulation 28. That's part of the reason where long-term institutional investors have been allowed to take as much as 45% of the assets under management offshore. But it also relates to low growth locally and therefore relatively low return in a risk-adjusted basis, which means in order to grow pensions for South Africans, we have to increase foreign exposure. We have to look for opportunities in other countries that are growing. So that's part of the reason why we are seeing capital outflows. It's a legislative amendment, but also is driven by the need to diversify potential risks, sources of return for pensioners and long-term investors locally, given that the South African market is becoming highly concentrated, listed markets becoming fewer companies that are listed. So to actually help South Africans, you need to give them a wider investment universe, which is obtained globally.
Thank you. A follow-up question on that was, why did we not succeed in cutting employment even during the time when we had capital inflows? We have been a significantly unequal society for way too long.
Indeed, this just boils down to leadership, taking the hard choices that are required, even when it's difficult to do so. I would put it this way: as a society, we tend to behave like, no offense to anyone in the call, but we tend to behave like overweight individual who never goes to gym until they are told by the doctor that you will suffer a heart attack tomorrow. Then all of a sudden we go to gym, we eat veggies all the time, but it might be too late. For some reason, we have tended to be able to turn around. And at some point in time, we will fail to turn around because we leave decisions for way too late. That's how we have behaved from an economic reform perspective. We have known the dilapidation in rail for a very long time. We have known the issues with Eskom for a very long time. In the late 90s, we were told we need to invest in new generation power, but we did nothing. But we have also known about the skills shortages from 1994, that the skills levels, we didn't have enough in the country, but we haven't done anything. We have also known about the special planning in terms of the roads and rail that are required to link people to economic opportunities, but you can count the number of new roads and public transport systems that have been developed since 1994. We have known all these things, but we haven't done anything.
Thank you, Isaiah. I'm going to do the last question from Gary. What is your view of the growing theme that we cannot use austerity to resolve our economic issues?
I think it's, yes, that view is correct. It's about the quality of spending. If we look at the decade to 2019, we increased our debt by almost R1 trillion. But what did we spend that money on? It's not, we didn't see significant infrastructure. We still have issues with our water infrastructure. We still have issues with our rail infrastructure. So we did not spend on quality spending that actually increases the efficiency of the economy in a way that generates jobs, which then says, as it stands, the type of spending that we have done did not help much in terms of economic growth and reducing inequality. So that's what we need to change. It's the type of spending that we do.
Thank you very much. Guys, we ran a bit over, but I'm just going to share my screen. Thank you so much, Isaiah, for presenting today to us on this wonderful topic that is very interesting, and I'm sure we can carry on for another hour. Guys, you are more than welcome to make contact with Isaiah directly on LinkedIn or via his email now shared on the screen. You're also welcome to give us some feedback on the session. And thank you once again for your resilience on joining us at a very late stage on a new link. And we thank you so much for joining us. Thank you, Isaiah.
Thank you very much.